Before we start, Andy, I just wanted to say a quick thank you to our podcast sponsors, Money Farm. Now, Money Farm are the largest digital wealth manager in Europe, and they create portfolios of ETFs for their clients. They're incredibly cheap and ideal for somebody who's wanting to get into investing, and perhaps for more experienced investors who don't actually want to run their own money anymore. Now, they will even offer to run the first £20,000 of any of our listeners' portfolio absolutely free if they enter the code MTTM20K into the website at moneyfarm.com. For more information, check out their website. But for now, Andy, let's get back on with the show.
Hello and welcome to episode 175 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, the weather has turned. It's amazing. What's going on?
Well, I don't know, Andy. It is amazing. We're in April and it's more like summer. But the flip side is that when you're doing a podcast indoors, in a room that you're trying to make as soundproof as possible, it does mean that it gets very hot with the windows shut. So I'm going to be a typical Brit and moan now that it's arrived. But yeah, it's been good, Andy.
Damien, part of the reason I sort of reference the weather is that I'm not as good as you. Unfortunately, I can't deal with the heat, so I have got a window open. So if you hear the birds chattering and a lawnmower in the background, then apologies. That's my side of the audio feed. I'll try and clean it up in the edit, but don't tell anyone.
Yeah, but I've been enjoying the weather actually. So, but I have been locked away at the same time because this week we've been doing a lot of behind the scenes stuff on Money to the Masses, planning the next year. So all businesses need to do it really. You sit down, you've had your year end, you plan what we're going to do next year business wise, what we're going to do with the website, the podcast, what we're planning for the whole Money to the Masses movement, brand, whatever you want to call it. So that's been quite exciting. It took 2 days to do that. So I've not been out as much as I'd like to be, but it's been fruitful nonetheless. And I think over time I'll be able to share more of that with podcast listeners as we move forward into 2018.
It's exciting stuff. I've got nothing as exciting as that's happened in the last week for me. All I can tell you is my beard is gone beyond what is a sensible beard for any human being. It looks ridiculous, so I'm going to whip that off this week. And the other thing I've been doing this week is pretty much in the garden, ripping up a patio and replacing it, which makes me feel like a man. Unfortunately, though, I haven't done it particularly well and it's still not level, but we won't tell anyone.
I'm impressed, Andy. I'm guessing your wife is still around. She's not under said patio or anything like that, because it would be slightly less impressive that I'm not going to give you a pat on the back. But I'm impressed you've done a patio.
She's still around, but yeah, it's certainly good practice. I shouldn't put that down to audio, should I? Because if anything, God forbid, happens to my wife in the future, this will be played out in the courthouse.
Yeah, but I didn't see her, by the way, before we started this.
So anyway, let's get on with the money stuff. What have we got on this week's pod?
Right, the 3 pieces that I've got for this week, there's going to be a piece on an interest rate trick. So this is something that is, if you want to take out a loan, a way of being able to take more money for less, which isn't just shopping around. So you'll be able to borrow more money, but actually it costs you less by doing so. I also want to talk about a piece of research that discovered what gives Brits the biggest buzz. There is a money element to this. It was done by a robo-advisor to get a bit of probably headlines, PR, whatever you have you. But it has actually got a few talking points around it, which wasn't their intention. I'm going to pick up on. And finally, if you're into investing, there's a piece on how to find funds for a falling market. Now, for 80/20 investors this week, I did a whole piece of research about funds for a falling market. Now, while I'm not going to tell you the ins and outs of that piece of research, I am going to give people a steer of how I would approach a topic like that, how I would go and try and find investment funds for a falling market, because it does seem like a pretty impossible task. So, which do you want to go with first, Andy?
Should we start off with the investing piece?
Well, let's do that. So, investing, what we've had, this came about because an 80/20 investor member asked me about how to find funds in a market that's had various dips, so a falling market essentially. Like this year, so we're 2018, so if you're listening to this in the future, it's towards the end of April now, and we've had 2 big dips in markets, and we're still in the middle of a potential sort of correction. We're trying to work out whether it's going to go higher. But of course, we could head a lot lower. We just don't know what's going to happen. Anyone who tells you that they do know is probably trying to sell you something. Now, they wanted to know, are there any funds, and in particular targeted absolute return funds? Now, that's a particular group of funds that are meant to make money in nearly all environments. They never do. But they wanted to know, how do you go about finding them? Because if you looked at some of the returns year to date, they did actually look pretty okay. Some of them looked like they'd made money. So what I want to do is give people a quick steer of how you could go about doing this and how I approach something like it. If you want to know the full research, the funds and the interesting findings that came out of it, then you can take a free trial of 80/20 Investor. Just listen to the little snippet stroke advert after this piece. Now, when I started this, I looked at the year-to-date stuff because this is what the person wanted me to do. They said, look, we've had year-to-date two falls. Some funds seem to do quite well. Now, if I want to try and find a fund for a market dip, what I would do is go and identify the most recent dip in question. I would also then try and understand why it happened. Now, to take this year, we had a dip in March in stock markets that was centred around the technology route. So when Facebook got caught up in a essential leak of data or sharing data with third parties that people weren't aware of, so that dragged down the technology stocks, and then that sort of filtered out to the wider stock market. So you could call that a tech stock sell-off. Then the one in February, if we remember, if you go back a few podcasts, was actually caused by bond yields rising. So it was actually when bond yields rise, bond prices fall. It's the way they're priced, they're moving opposite directions. So it was an earthquake that happened in the bond market that then moved into the stock market. So both bond markets and stock markets fell in February, but it was very much a bond-centred event that caused it. And so if we look at those two events, what I would do is go, right, let's have a look at how those funds that seem to have done quite well over this period of time, how did they perform when the market threw a wobbler? And I'm talking about from sort of peak to trough, because that drawdown is what they call it, is what you're interested in. If you want to try and preserve capital and try to avoid the worst of a fall, you concentrate on those bits. So by doing this, you're trying to find and see how funds behaved. And now I'm going to call this, it's kind of was it Bananarama who did the song, It Ain't What You Do, It's the Way That You Do It? Was it Bananarama, Andy?
It could well be. I know the song for certain, and Bananarama around that era. I'm not an expert in 80s music, especially not.
So I thought you were, Andy, as a man who was a DJ, one of your many business ideas. I thought you'd know that sort of thing.
And to be fair, my mum used to run the fan clubs of many 80s music stars, so I should know, really.
But you should do. The reason why I bring that up is because if you just look at statistics and data over a longer period, what you really want to see is not just what a fund did, but how it did it. So if a fund seems to have made money this year or over a period of time, you might be thinking that's okay. It's actually held up okay, even though stock markets are still down. But the problem is that you want to see how it did it. How did it behave in those falls? Because while history doesn't repeat, it often rhymes. So if you know how a fund behaved in the bond-focused sell-off in February, which leaked into stock markets, and the tech sell-off in March, then you might have an idea of how it might perform in a future sell-off. So what you're looking for is the periods where there was stress and see how it performed. Now on 80/20 Investor, I have created, it's still there, I created a tool that looked at, it was a stress test tool, and what I did was go back to previous key points in market movements and what caused them, whether it was something to do with China or whatever, and you could see how funds and test how they performed in those periods, so you can then try and make a judgment call of maybe potentially how they might perform going forward. If you do that, I would always say place more weight on the most recent data, because portfolios will change. Fund managers do change their portfolios, although they don't do it wholesale, so they don't tend to veer wildly from an asset allocation. They will make changes depending on what's going on. So what you've got now, you've seen some that seem to be winning, you've looked at how they performed in those downturns, and then what you want to do is try and screen out some of those that have performed badly in the most recent downturns and in case there's a repeat. But you also want to have a look at how they performed after the worst of any sell-off. And the reason you want to do this, because most people won't, and the reason you want to see how they perform in the good times, is that a fund is unlikely to avoid the worst of the sell-off and enjoy the best of any rally. If it did, then that person would be a genius who was running that fund, and therefore they would be living on a beach somewhere, not investing other people's money, but just sitting on a pile of cash. So what you want to do, the reason you need to see how they occur during maybe the slight rebound or recovery phase, but also across a series of dips, is because it gives you an inkling about, like I said, it's not what you do, it's the way that you do it. And you may find that a fund that appears to do well in a sell-off actually does very badly when the market rallies, because it may be using strategies that benefit from a particular scenario, whether it's China's economy imploding or currency moves or something like that. And so what you need to do is see what it's doing the rest of the time, because if during the rest of the time it's doing dismally and it's performing badly, then what the fund that you found that is winning in a downturn is probably going to cost you in a rising market. And don't forget, we are still at this point clinging to a bull market in equities in particular, so they're still rising. So you might want to question how it performs and whether you want to go into a fund, for example, that is shorting the market, it's betting against it. Now, I remember going to a fund manager lunch years ago. We used to do this where you go along and then they sit there and you have food and the fund house pays for all that, and then you sit there and listen to a fund manager go through why he thinks what's going on in the world, why his fund is positioned.
Damien, that just sounds riveting. I have to say that a free lunch does not outweigh the having to sit through that. But
Andy, you don't know how right you are. I used to want to. I'd almost rather stick pins in my eyes than do that. I refuse to do it now, and I don't need to. But at the time, I was working for. Obviously, I was employed by someone else, so it was kind of I was duty bound to do it, and that's what IFAs do. You go in this room, there's loads of financial advisors and people who pick funds. And it's really an element of smoozing, but also a way of trying to persuade them. So it's not just smoozing, it's trying to sort of show them what's going on under the bonnet of their fund. Now, I believe if you do your research enough, you don't need to go and meet the fund manager, because you can see what it's doing. As I said, it's not what it does, it's the way that it does it. So you can see if a fund is an absolute dog during a period of time when, let's say, equities are rallying, you know that the guy is not betting on markets or equity markets rallying. Now, this guy in question, he was basically betting, I won't name the fund, but he was betting on an Armageddon scenario, that this is all bonkers, this QE, all this money printing can't last, and it's all going to end in a spectacular crash, and it's going to mean bond yields rally. So basically QE people buy, the Bank of England and all the central banks buy bonds, so they skew the market. It's going to implode, it's going to all reverse, so the price of bonds is going to collapse, blah blah blah. And he has placed the house, or his mortgage essentially, he's bet everything in the fund on that outcome. The problem is that if you bet on Armageddon, then, or the end of the world, you'll be right at some point, but you'll be amazed at how long central bankers and politicians and people can distort reality and put off the inevitability of some form of day of reckoning if they need to. So that guy is still, therefore, or had been doing badly. His fund will have done very well in certain scenarios like this. So where we had the correction in bond markets, his fund would have done quite well. So what you want to see is, just because his fund, you might discover his fund, go, oh, that looks good, that's going to do well. You've got a time frame or a very short window. You need to look what happened to the fund in the previous 6 months, the previous year, because then when you look at that, you'll see, God, that fund was appalling last year. When the rest of the world was making money, you could almost make money by accident in 2017. He was losing money hand over fist. And of course, he may now be making money where there's a correction, but if things revert back to how they were, then he's soon it's gonna unravel, he's gonna be losing money again. So it's really trying to get you to focus on the downturns, but then take a zoom out and just have a look how it's doing in relation to the rest of the market over a slightly longer period of time, because by doing so, you then start to work out what the fund is really doing and what you can expect going forward. Now, if you find a fund, like I say in this article, I pick out some. If you find a fund that you like, then don't overcommit to it, because if it is doing something that might be betting against the market, great. You didn't realise there were funds out there that did that, but don't overcommit. Now, one way, if you don't want to get bogged down in lots of research, there's an easier, dirtier way of maybe doing this research. You won't necessarily come out with such exciting answers the way you could be making money from a falling market. You might just be preserving capital more. You might just get some boring funds that don't do much, that trundle along, and you're only making barely more than cash. I would suggest if you go and look at the sites that have fund data, so Morningstar, TrustNet, if you look at returns, that's great, and you can't be bothered to go through and see how all the funds have performed over periods of time, you can screen on volatility. So that's the up and down, the zigzag movements. It's the crazy swings that the fund has done. If you go for something that's got a low volatility, then it will, but I'm talking relative to its peer group. So it's got a very, one of the lowest volatilities in its peer group. That means that the price, it's almost flatlined. It's kind of dead. It's just plodding along. That means it's doing something that is uncorrelated to its peers and also the market. But you also want to look for something that's going to give you a cash plus a bit return. So there's no good having a fund that's not lost you money, but it's actually over time just constantly loses you money. Do you know what I mean? Slowly, the charges eat away. You want to make a bit more, because the ultimate way to make money in a falling market is to sit in cash. Cash is king. It was king in February. It was king in March. So it's a horrible phrase that comes from an investing world, but cash can be king. Don't forget that cash can be a destination rather than just a starting point, because people who invest think, right, I've got money, I've got cash, I've got to invest in something. But you're not compelled to invest. Fund managers are, because that's their job. So they can't sit in cash even if they think Armageddon's coming, because their remit, their job is to invest. So if you're going to go for something that's got low volatility and it gives you something more than cash, the chances are you're going to get a very boring fund, but you're going to get a fund that preserves capital. So that's the easy, dirty way of getting it. But if you look at the other ways, like I said earlier, the kind of how-to way of looking at specific areas, zoom in, then zoom out, you might find funds that actually make money in falling markets. But there you go. So it's not what you do, it's the way that you do it. Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insights, you get market commentaries, monthly commentaries, and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers, and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
Okay, so Damien, loans, interest rates, you're going to tell us a trick.
But the trick came from some research from a firm called De Facto. Now, I'll give them credit, they did the research. They are a firm that does, they rate lots of products. So they do things for loans, they do things for, they used to do things for investment products, I think they still do. Now, they did a lot of research around interest rates on specific loan sizes. So we're talking personal loans here and unsecured loans. And there is a sweet spot they discovered that around £3,000 and around £5,000, that if you take a little bit more of a loan, so you increase your loan ever so slightly, you can dramatically decrease your interest rate and the amount of money you repay each month. So I'm going to give you an example that will just beautifully illustrate the point. If you decided you needed a loan for £4,900, then with Lloyds, there's their example, you would have an interest rate of 23.9%. Okay. Now, if you took a loan for £5,000, so just £100 more, which might not be what you want, then that interest rate drops to 9.9%. So that's a 14% drop in the annual interest rate on that. That would save you £27 a month and nearly £1,500 in interest payments on a £5,000 loan over that time. So it's just, there's sweet spots, there's clear cut-off points with loans where you move into a slightly higher bracket that gets you a better rate. So if you're going to get a loan, of course, shop around is always going to be one of the biggest tips. But even if you do consider what rates, or look what rates you can get for a loan that's marginally bigger. I'm not trying to encourage people to take out more debt than they need, but £100 on a £4,900 loan is nothing. You'd actually save money by taking out an extra £100 on a loan.
That's really interesting. So would you say that if you did that, for example, you could almost put that into the bank and use that as part of your repayments and kind of double down?
Yeah, you could do. You take that and that could be the first payment back you didn't want. So you didn't want the £100. So ultimately, I just think it just shows you how the system works, and you can play. You just have to shop around, do a bit of homework, like the investment piece I did before. Do it on interest rates, and you can save money.
Yeah, that's really interesting. Okay, last piece. What we got?
It's to do what gives Brits the biggest buzz. Now, this is a piece that was done by, it came from some research by a robo-advisor, like Money Farm, but this one was Wealthify. And what they did is they went out there and they asked a whole bunch of Brits a series of questions, trying to work out what gave them a buzz, for want of a better word. And they came up with a top 10, and it is related to money. Now, the top 10, I can just imagine what people thought when they were going through this. But the top 10 things that give people a buzz...
Is this clean? It's not X-rated, is it?
Well, the thing is, Andy, you just hit the nail on the head, because I think if you ask enough Brits what gives them a buzz, it's inevitably going to be X-rated, because sex is one of the things on the list. I'm not quite sure whether they just came up with that or it was actually a tick box. But the top things were going on holiday. 82% of people, this gave them a feel-good buzz. Then having a child... Having sex was third, which is quite interesting that having a child was second, and it was above having sex. It's good to see the order was in the right way round.
Yeah.
When clearly not just a randy bunch that just goes and has sex and then, do you know what, don't care about having children. 4 was being promoted at work. 5 was making a return on their investment. I'm sorry, I just don't buy this, but they've got an excuse. I can just imagine that the company went, right, we've got to make money sexy. How are we going to make money sexy? And we're going to get some investing sexy. So what they've done is they've just pretty much just got sex and money and just mashed it together into a piece of research yeah. In a very clunky way, I think. 6 is bagging a bargain when shopping. 7 is losing weight. And 8 is getting the housework done. Goodness me.
Wow.
I can't believe that is on the thing that gives people a buzz.
Well, I can kind of understand it, because I've been out in the garden this week sorting out the patio and pruning the hedges and stuff. And do you know what? It is really satisfying after a couple of hours hard work to be able to look, and it's quite a quick win.
What? Look at a wonky patio, Andy. Did it give you a real buzz?
The thing about housework and gardening, though, it's kind of quite tangible. You can see the work. You know, it's there. You can see what you've done, and I suppose that. The thing about getting a buzz, there needs to be like an instant reward, and otherwise, if it's extended over a longer period, the sort of feel good factor is washed out. So I can kind of understand it, albeit very, very sad. People getting a buzz off of things like that. I'm sad though. I've got a buzz off a wonky patio this week.
I think you should come around my house, Andy. I've got plenty of hires for you and buzzes if you want. I've got a garden that needs tidying up. I need a patio that needs cleaning. So
I've got one of those pressure washers. They're such good fun.
Yeah, till you shoot your foot when you got flip flop on, and you decide I've got a bit of dirt on my foot, and you blast your foot like I did one year and almost took the skin off my foot. Anyway, so the rather strange piece is that there were 15% of men that claimed that investing gives them a buzz similar to having sex, which again I think they probably need to enjoy life a little bit more. apparently 4% of women said the same thing. So I'm not sure, because there's obviously a whole bunch of men that probably think the same as well. They're probably it probably goes hand in hand. It's 3 times as many men thought that. So there were other things that gave them a similar buzz, like I said, losing weight, shopping, and going on holiday. But one of the things that is quite interesting about the research is, I'm going to change it from what they intended it to be. People are always interested in benchmarking, and it's one of those things that I can sometimes call it like the terraced house syndrome, where you look out your window and you notice your neighbour's got a new patio that they've laid slightly wonky, and you go, I want a wonky patio. I want a wonky patio too. Shall we get a wonky patio? And so it's that envious thing, and you like to benchmark yourself. So they asked people why they invest, and these are the reasons, the top reasons why they invest. And it was saving for a comfortable retirement. That's why about 40% of people invest. Making their money work harder for them. Generating an income was third. Feeling more in control of their finances. That was 24% of people invested for that reason. Beating inflation and improving their lifestyle. Now, notably, saving for your children's future was missing from that, which I was surprised, given that they were seemingly wanting to make babies quite high on the previous list I said. So I was quite surprised at that. But the benchmarking element is, lots of people, that's why they do it, but how many of those people, how many people out there actually have already achieved this ambition? Now, only 18% of people out there have achieved their ambition of saving for a comfortable retirement. That doesn't surprise me that it's so low. 24% to make their money work harder for them. They've achieved that. 22% to generate more income. 17% of people said that they're investing. They've achieved the aim of feeling more in control. 10% who invest reckon they've beat inflation, and 9% people think they've managed to improve their lifestyle. What that list does is show you that most people out there are still way off achieving their ambitions, but it doesn't stop them. It's not a reason to not invest. So one of the things that I find when people email me, they see the Everest mounting in front of them of what they're trying to achieve, i.e. that comfortable retirement, and therefore they're put off even trying and don't bother. And they think everybody else out there is doing it. And the idea that if you just start small, start putting a little bit away and start investing with any spare cash you have, you will already be beating 80% of the population, or get in there. And it's self-fulfilling. Once you start seeing the money grow, you will then inevitably probably try and increase that. So it's not quite what their research was trying to say. It was just a kind of angle to get the word sex into it. But it does show you that there are a lot of people out there who are trying to invest, but there are plenty of people who are just like a lot of people who listen to this podcast who have not achieved their aim. But it's not a reason to not invest. So it's an encouragement rather than, I don't want people to think, oh, that's all right, I don't have to bother because I'm the same as everybody else. You've got to take control of your own money. Now, the one quick criticism I have got about a lot of the things in this list, that the things they compared the buzz from investing to, so they said, for example, having a child, being promoted at work, or losing weight, or anything like that. A lot of the things they're comparing the buzz to, or they think they're going to get the buzz from, were very short term, which goes back to the point that you were kind of making just a moment ago, Andy, is that there is a buzz of short-termism buzz about it when you do something. So it could be like the housework or whatever. But investing isn't like that. And I think the danger is if we try and encourage people to go, yeah, do you know what? You can get a buzz like going on holiday if you invest money. The reality is you won't. Investing is a get-rich-slowly angle. It is not exciting unless you're going to go and speculate. If you're going to go and bet the house on Bitcoin or get into trading on individual shares, it's exciting, but that would be frightening at the same time. You're going to end up being a slave to the market and having sleepless nights. Investing for the long term is rather less exciting. It's more about trying to 80-20 was trying to 80-20 investors all about trying to make that journey as easy as possible and helping you minimise the time you spend on it, so you do get a bit more of a reward because you're spending less time on it, and hopefully try and boost return. But trying to liken and say to people, yeah, if you invest money, it's 15% of guys think it's just as good as a sort of a roll in the hay. It's not. So I do think the research does a disservice to what actually people expect. So when they start, they're going to be disappointed. So invest for the long term. It isn't going to give you a massive buzz, I don't think, but you can achieve your aims. So there you go, Andy. That's the end of it. But before you switch off, there's an important piece of kind of admin, really, that I want to tell people about next week's podcast, because there isn't going to be one, Andy, and this is going to be news to you. You don't know this yet, so you're going to have a week off.
Okay.
Has that given you a buzz?
Yeah. Well, no, actually, no. I enjoyed it. Well,
it was number one on the going away on holiday. I think that could be likened to that, because the truth is that's pretty much what I'm doing. In the next week, I'm not going to be around for a period of time, and I'm having a break because I don't mind admitting that in the not too distant future I'm going to be hitting the big 4-0. So I'm having to celebrate that. I'm having a mini break. So there won't be a podcast next week. There will be one the week after, so we'll be back. So don't go anywhere. Make sure you keep subscribed. I know, and as part of that, I mean, it is a child-free break as well. So I'm having people come and my parents are going to house sit, so it does mean I've got to clean my house up. So I'm going to get a good feel-good factor, apparently, by doing all the housework ahead of them coming to stay for a few days. But going back onto our previous podcast about currency exchanges, and I actually took some of our own advice, took some of our own medicine on that one, and took out one of the exchange cards that we talked about on a previous podcast. So go and have a listen if you're going to go away, how to get pretty much the perfect exchange rate.
Fantastic stuff. We'll have a lovely time on holiday next week, Damien. And if you do want to get in touch with Damien, ready for the podcast in a couple of weeks' time, we can answer your questions on this podcast, or if it's regarding anything else. Twitter, it's at Money to the Masses with the number 2, or it's podcast at moneytothemasses.com. Damien, we're done.
We're done. We've finished, Andy, and until next week. Well, no, actually, sorry, until next time, I should say.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.